Hey, what's up, everybody? I have an exciting announcement. Yes. All right, we are having the first annual MMT Trader dinner in New York City on November 10th. If you'd like to attend, please go to my website, pitbulleconomics.com/MMT dinner. And you could sign up. The cost is $250 per person. That is a Saturday. We'll be having a lot of fun. It is being held at Harry's of New York City. That's a famous Wall Street restaurant right in the heart of Wall Street in the financial district. Yeah. So if you want to come, everybody's invited. There'll be drinks and dinner and discussion, and I'll tell some stories. You get to meet other subscribers, or if you're not a subscriber, you could meet other members of our SEAL Team 6. Maybe you'll become a subscriber or a follower. A lot of fun, a lot of revelry is what I expect, so I'd like to see everybody there. Again, go to pitbulleconomics.com/MMT dinner to sign up. The cost is $250 per person. Or you could send me an email at mnorman@pitbulleconomics.com. All right, let's talk markets. We have seen over the last several days a pullback in the U.S. dollar. Today it is catching a bid once again. Dollar index is below 95. The bid just happened basically on news that Trump has instructed his aides to go ahead with tariffs on $200 billion. Same old stuff over and over and over again. Same old stuff. This is like a merry-go-round. He imposes tariffs. The zombies react reflexively. The markets do their risk-off trading. Stocks down, bonds up, gold down, and commodities down, dollar up. And then it all reverses again. So, I mean, this is so predictable. It is unbelievable. So predictable. It is unbelievable. Earlier today, the 10-year Treasury yield hit 3%. Now, you know I have never wavered on the outlook on interest rates. They are going up. You do not predict lower interest rates when the central bank is committed to raising rates. You short the Treasury. I'm originally short the 10-year at 127 on the futures. It's down to 119. All right? That's $8,000 per contract. If you had 10 contracts, that's $80,000. All right? You can do the math. That has been a big winner. So the 10-year yield is going to continue to rise. Why is it rising slowly? Or let me put it this way. Why does it look like it doesn't want to break above? Because there's hesitation. The Fed has been very slow and cautious on its rate hikes. The market has constantly been second-guessing the Fed's intentions, and every time they see a sort of weakish number, they buy the bonds, but it's the wrong thing to do. It has nothing to do with inflation, folks. Let me tell you that. Inflation could be zero. It could be negative. If the Fed wanted the 10-year at 10%, they could put it at 10%. They set the price. They set the yield. Very simple, and it has nothing to do with where you are along the curve. Duration has nothing to do with it. It might have something to do with it in the very short term if market participants are questioning the Fed's resolve. But I'll tell you this right now. If the Fed wanted the 30-year at 20%, it wouldn't even have to do anything other than just state the rate. We want the 30-year at 20%. It would go there instantly, because nobody is going to step in front of the Fed. So that is the reason it has been happening slow. The Fed has been openly kind of cautious and proceeding gradually on this. It says it in its statements, gradual, so the market is not sure how long it's going to last, how far it's going to go, so that's the reason. But they're going to continue to go, and as I have said many times in the past, rate hikes, well, there are a number of things. Number one, they are price increases, because the cost of credit is reflected in all goods and services, and there's It's well documented, by the way, that inflation follows interest rates. And I've said this also many times. You can go back and look at a chart of the CPI. It bottomed out in December 2015 when the Fed reversed course on interest rates. And so did gold, for that matter. In spite of the big correction that we have seen since, April or something like that. In spite of that correction, we have seen the price of gold rise over the 7 rate hikes that we have had so far from the Fed. We're going to have another one this month. September 26th, we'll get another one. All right. Then they break for October. Then they have November, and then December we'll get another one. So rates are going up. By the end of the year, the 10-year yield will be easily above 3% and steady above 3%. I will make that prediction now. So what rate hikes are? Number one, price hikes. And number two, they are fiscal expansions. The government is a net payer of interest. When it raises rates, it necessarily causes the government to spend more money. Now, that money is not distributed equally, but what is? Look, we have had an enormous increase in payments to defense vendors, defense contractors. That is up. Well, the total amount is about $280 billion. It's one of the biggest individual line items of expenditure. It is up about $35 billion over last year. By the way, last year at this time, payments to defense contractors were down $2.7 billion. Now they're up like 33 or 34 billion. So we've had a 35, 36 billion positive swing. Where does that money come from? Congress just says, okay, now we're going to give. You don't believe in socialism? This is military socialism, military Keynesianism. Works very well. Look at the stocks of defense contractors. They've been on a tear for a long time. The government is handing them money. That increase is less than the increase in Social Security. And Social Security is the largest single line item of expenditure. It's up only about 2.7, 2.8% year over year. Payments to defense contractors are up almost 12% year over year. So think about it. Works very, very well. Just look at the stocks of defense contractors. It works for interest too. If you look at interest payments, about 260 billion so far this fiscal year. That's up about 12 billion over last year. 12 billion is a big number. It may not seem like a big number in GDP, but it all adds up. It's bigger than many, many programs, many spending programs. So rate hikes are price hikes, and rate hikes are fiscal expansions. Rate hikes are inflationary. Rate cuts are deflationary. Now, along those lines, we saw, and I have to be honest about this, I have to confess, yesterday, or maybe it was the day before yesterday, the Turkish central bank raised interest rates by 625 basis points at 6.25%. Bad move. Bad move. And I thought Erdogan was in control over there. That was the rationale I had when I said the Turkish lira was going to rise, whatever it was, a couple of months ago. He's obviously not in control. The central bankers are doing their thing. So what happened? Yesterday we got a rally in the Turkish lira, but that's not going to last. So that's bad policy. And we saw the same thing in Russia today when they raised interest rates. Putin has surrounded himself with these neoliberals. It's all the wrong stuff. It's all the wrong economics. So that's not going to help the ruble either. That is going to weaken the ruble. So there you have it. The merry-go-round continues. Trump says something. There's a reflex reaction. The zombies all do one thing. We do the opposite. We make money. All right. Don't forget the dinner, the MMT Trader dinner, First Annual. We are going to grow this community. You have a chance. You meet me. You meet other subscribers. If you are a subscriber. If you're not, you can come down. Have dinner, have drinks, have a good time with us. Hear some stories. We'll talk. Everybody's going to have a great time. Go to pitbulleconomics.com/MMT dinner and sign up. See everybody there. Bye-bye.